Welcome to your deep dive. Today, we're cutting through the noise to get you truly informed on a company that, well, shapes our everyday sensory world, Sensient Technologies Corporation, or SXT on the NYSE.
That's right.
They are, in many ways, the hidden architects behind the very taste, texture, and appearance of so many products we encounter every single day.
You probably use something with your ingredients today already.
Almost certainly. What's particularly intriguing about Sensient right now is that our sources suggest they are navigating a cyclical trough towards secular growth. That sounds like a fascinating journey, doesn't it? From a temporary dip to long-term expansion?
It truly is a journey, and our mission today is to understand precisely what that means for Sensient. We'll be extracting key insights from a pretty comprehensive analysis framework,
Okay.
trying to grasp their business model, dissect the recent macroeconomic headwinds they faced, examine their strategic response, and ultimately, paint a clear picture of what their future prospects look like.
Especially in what is a highly competitive yet fundamentally growing industry.
Exactly. We're going to synthesize financial reports, press releases, and deep industry data to give you a clear, actionable understanding of this critical player in a global value chain.
Think of it as peeling back the layers.
Right, to see what really makes them tick. The sensory architects. Who is Sensient and what do they do?
So, to truly appreciate this journey of recovery and growth, let's first get to know our main player, Sensient Technologies.
Good idea.
Who exactly are these sensory architects we're talking about, and what magic do they work behind the scenes?
Well, they're what you call a leading global manufacturer and marketer of high-performance specialty ingredients,
Okay.
with a primary focus on colors and flavors.
Right. So when we talk about how a product tastes, how it feels in your mouth, or, how appealing it looks, Sensient is often right there, invisibly defining that sensory experience.
Yeah, they're the secret chefs, kind of.
Behind so many products, ensuring our candy isn't just sweet, but also the perfect shade of gumball blue.
Exactly. And that perfect shade requires incredibly complex chemistry. It's not trivial stuff.
No, I bet.
What's fascinating here is their critical position in the value chain.
Okay, explain that a bit.
To visualize their critical position in the value chain, think about it this way. Sensient isn't selling like basic flour or sugar.
Right. Commodities.
They're selling the highly specialized flavor that makes your favorite sports drink unique, or the natural color that makes a yogurt look appealing. They're positioned between the raw material producers and the massive consumer packaged goods, or CPG companies.
Ah, the big brands.
Yes, acting as the crucial innovation and technical bridge that translates fundamental ingredients into compelling consumer products. They serve defensive, non-discretionary end markets.
Meaning?
Things like food and beverage, pharmaceuticals, personal care, and nutraceuticals.
And nutraceuticals are?
Products at the intersection of nutrition and pharmaceuticals. Think fortified foods, functional beverages, dietary supplements, stuff offering specific health benefits beyond just basic nutrition.
Got it.
And these are all industries where demand tends to be relatively stable, regardless of economic ups and downs.
Because people always need to eat, stay healthy.
Exactly. Take care of themselves. Their products aren't just additives, they're essential components that directly shape the consumer's perception and experience of a product. That makes them highly valuable.
So it's not just a tiny cost for a massive impact. It's almost like they're selling the soul of the product for pennies.
That's a good way to think about it.
Is it fair to say they're selling solutions, not just products? And what's the hardest part of convincing a big CPG company that a sensient ingredient, though a tiny cost, is actually worth that premium collaboration?
That's a great way to put it. They absolutely are selling solutions, not just raw materials. The penny cost, massive impact dynamic is exactly what makes their value proposition so powerful.
Right.
For a major food or pharmaceutical company, getting a flavor or color just right and ensuring it holds up to complex processing, various packaging methods, and a long shelf life. Well, that's an incredibly complex scientific and engineering challenge.
I can imagine.
The hardest part isn't convincing them of the cost of the ingredient itself, but rather the cost of not getting it right.
Ah, the risk.
Exactly. If a product's taste or color is off, if it degrades over time, or if it doesn't meet regulatory standards, the cost to the customer in terms of reformulating, retesting, potential recalls, or worse, irreparable brand damage is astronomically high.
Huge potential downside.
So while Sensient's ingredients typically represent a small fraction of a customer's total cost of goods sold, their impact on the final product's quality, brand identity, and consumer appeal is disproportionately large.
It's an investment in brand integrity.
Precisely.
And that disproportionate impact translates into incredibly deep collaborative and long-lasting relationships with their customers. It creates a significant competitive moat.
A very deep moat.
When some major food manufacturer has developed a best-selling cereal or a popular yogurt, and a sensient color or flavor is perfectly integrated into that formula, well, the cost and complexity of switching suppliers for such a critical ingredient are often prohibitively high.
You really can't just swap it out.
No, you can imagine having to reformulate a product that consumers know and love, then retest it for stability, shelf life, and regulatory compliance, and finally relaunch it with a potentially slightly different taste or appearance. It's a massive, costly, and risky undertaking.
Yeah, heads would roll if that went wrong.
This stickiness, this deep embedding of their products into customer formulations creates a significant competitive advantage for Sensient, making their revenue streams remarkably stable once established.
That's right.
It's not like they're just selling a product off the shelf like buying a car. It's more like they're getting a continuous royalty or subscription fee for as long as that customer's product is on the market.
That's a very apt analogy. It effectively becomes a recurring revenue stream with very high switching costs for the customer, locking in long-term demand.
Okay. Now, to fully grasp Sensient's operational footprint and how they generate their revenue, it's helpful to break down their business. They actually report their performance across 3 distinct segments.
Yep, 3 main parts.
Let's start with their largest piece of the pie, the Flavors and Extracts Group.
Okay.
This segment generated $741.1 million in 2023 and grew to $793.7 million in 2024. So, quite sizable.
It's the biggest chunk, yeah.
This group offers a wide range of flavor systems, natural extracts, and functional ingredients. It serves primary end markets like beverage, savory. Think about the complex flavor profiles in soups and sauces or marinades.
Savory is big for them.
Sweet products, which includes confectionery and bakery items, and bionutrients.
Right, which are fermentation products used in food and pharmaceutical applications. Specialized stuff.
Okay.
And management has articulated a clear, sort of 4-pronged value proposition for this segment, which is crucial to understanding how they compete.
What are the pillars?
It's centered on providing industry-leading customer service, delivering fully formulated product systems to accelerate customer speed to market.
Speed to market, always key.
Absolutely. Then, ensuring superior product performance in both taste and function, and engaging in best-in-class marketing collaboration with their clients.
So fully formulated product systems, what does that actually mean in practice?
It means they're not just sending a drum of a single flavor compound. They might, for example, co-develop an entire cola flavor system that a beverage company can drop directly into their new product development pipeline.
Ah, like a ready-made solution.
Exactly. Or create a complete savory seasoning blend for a snack manufacturer. It's a holistic solution designed to get the customer's new product to market faster and with greater confidence.
So it's not just selling a raw material.
No, it's providing a comprehensive partnership. Much more involved.
That makes perfect sense. Now, the color group. While it's the second largest segment, with revenues of $608.8 million in 2023 and $647.9 million in 2024, it's particularly important.
Very important strategically.
It's a global leader in providing color solutions for food and beverage, pharmaceutical, and personal care industries. And what's particularly compelling about this segment is that a significant portion of their business is dedicated to the development and production of natural colors.
Derived from botanical sources.
This isn't just about making things look pretty, it's about meeting a massive consumer trend, which I guess we'll dive into more deeply in a moment.
We will. But the core insight here is that Sensient isn't just selling colors. They're selling a solution to a massive, complex problem for food manufacturers.
Which is?
How to replace synthetic ingredients with natural ones without compromising taste, texture, or shelf life. It's a huge technical challenge.
Right, and this is where the profitability comes in.
Exactly. This persistent profitability gap is a defining characteristic of Sensient's financial profile. In 2023, the color group achieved an operating margin of 17.3%.
Okay.
Substantially higher than the Flavors and Extracts group's 11.8%.
Wow, big difference.
And this pattern continued into 2024 with margins of 18.5% and 12.2% respectively.
So consistently more profitable.
It's not an anomaly. It reflects fundamental structural competitive advantages. The color group's business is centered on the incredibly complex and technically demanding conversion from synthetic to natural colors.
Driven by consumers.
Yeah, this global trend is driven by powerful forces of consumer preference for clean labels, meaning simpler ingredients you can recognize,
We all look for that now.
and also increasing regulatory scrutiny on certain synthetic ingredients like titanium dioxide, which is being phased out in many applications globally.
Okay.
Executing this conversion from synthetic to natural is a significant challenge for food manufacturers.
How so?
Well, you can imagine a natural color derived from, say, a carrot might not behave like a synthetic dye. It could be sensitive to heat, light, or pH levels.
Ah, stability issues.
Right. Changing its hue or even impacting the taste or stability of the final product. This requires deep expertise in formulation, stability, and application support to ensure that a natural color performs identically to its synthetic predecessor.
Without negatively affecting taste, texture, or shelf life.
Exactly. That's the holy grail. And Sensient's significant investment in research and development and its robust food safety and traceability platform, the Certisure program, directly addresses these complex customer pain points.
We'll talk more about Certisure later, I assume.
Definitely. But these high-value services create a significant competitive moat, allowing the color group to engage in value-based pricing and command structurally higher margins.
Makes sense.
Consequently, the color group stands as the primary engine of long-term value creation for the company. It's truly a hidden gem within the company where a lot of the future profitable growth is expected to come from.
Okay, good to know. Finally, the Asia-Pacific Group.
The third segment.
It's managed geographically, marketing and selling products from both the flavors and colors portfolios across the region. It generated revenues of $146.1 million in 2023 and $162.5 million in 2024.
Smaller but growing.
Serving as a direct indicator of demand trends and the company's penetration in this crucial long-term growth market.
Absolutely critical market.
The Asia-Pacific region, while smaller in revenue for Sensient today, is absolutely critical for long-term growth. It's driven by what? A burgeoning middle class?
Yep, rising income,
Yeah.
evolving dietary preferences towards Western-style convenience foods, and growing demand for health and wellness products. Sensient's ability to localize flavors and colors for specific regional palates will be key to unlocking that massive market.
Okay, so Sensient operates a business-to-business model, serving many of the world's largest CPG companies.
B2B, yes.
A key metric management often talks about is their new win rate. Explain that.
It's essentially how often a Sensient ingredient gets chosen or specified for a customer's brand new product, or even a reformulated one.
And why is that so important?
Because each win isn't just a one-off sale. It establishes a recurring revenue stream that persists for the life of that customer's product.
Ah, back to the stickiness.
Exactly, creating a stable and predictable base of business for Sensient. Also, given their global footprint, their results are subject to foreign currency translation effects.
Forex issues.
Right. So they often report performance on a local currency basis to provide a clearer view of underlying operational trends, removing the noise of currency fluctuations from exchange rate swings.
Makes sense. You want to see the real business performance too. Riding the waves. Industry trends and market defenses. Okay, let's zoom out now to the broader market and see where Sensient fits.
The bigger picture.
They operate within the large and steadily growing specialty chemicals and food ingredients markets. And when we say large,
We mean large.
to put that in perspective, the global food ingredients market alone is valued at somewhere between $270 billion and $350 billion in the 2021-2024 period.
That's, enormous. Roughly the entire GDP of countries like Denmark or Singapore.
It's a colossal industry. Various market research firms project a compound annual growth rate, or CAGR, ranging from 4.8% to 6.2% over the next decade.
Solid growth.
And the broader specialty chemicals market, which includes food ingredients, was estimated to be worth over $900 billion in 2024, with an expected CAGR of approximately 3.9%.
So Sensient isn't just playing in a big pond. They're in an ocean and it's getting bigger.
Providing a stable and expanding economic backdrop.
Right. But what's fascinating here is that even more important than the overall market growth are the powerful secular trends within the market that directly favor Sensient's specialized portfolio.
Secular trends meaning?
Long-term shifts in consumer preferences and industry regulations that create sustained demand for what Sensient offers, almost regardless of broader economic cycles. These are the big waves they're riding.
Okay, like what?
First, and arguably the most significant tailwind, is natural ingredients and clean label. This is a huge shift in consumer behavior.
Definitely see this everywhere.
A growing majority of consumers are actively reading labels and expressing a strong preference for products with simple, recognizable, and natural ingredients.
Guilty as charged.
Research indicates that over 60% of American consumers view natural products as superior. I mean, I always look for that short ingredient list on the back of products these days.
Me too.
And it sounds like Sensient is directly capitalizing on that consumer behavior. This trend is the primary driver of the global food colors market, where the natural colors segment is specifically forecast to grow at an 8.7% CAGR.
Wow, 8.7%. That's much faster than the overall market.
Substantially outpacing the broader ingredients market. This directly powers demand for Sensient's color group, which, as we just discussed, has strategically focused its innovation pipeline on natural color solutions and earns higher margins doing so.
Smart move. What's next?
Second, health and wellness. Consumers are increasingly looking to food not just for sustenance, but as a tool for managing their health.
Food is medicine, kind of.
Exactly. This manifests as demand for products with functional benefits like added vitamins or probiotics, as well as products that eliminate or reduce perceived unhealthy ingredients like salt, sugar, and fat.
A better for you trend.
Right. This supports demand for Sensient's flavor modulation technologies, which are crucial for helping manufacturers maintain appealing taste profiles in reduced sugar or reduced salt formulations.
Because taking out sugar can ruin the taste.
It really can. And also its portfolio of natural extracts that may offer functional benefits.
Okay. Third trend.
Third, visual appeal and sensory experience. In our visually driven culture, heavily influenced by social media.
Instagrammable food.
Precisely. The aesthetic appeal of food and beverage products has become a critical purchasing driver. People eat with their eyes first, and a visually appealing product can literally go viral.
True.
Color and flavor are the foundational elements of this sensory experience. Manufacturers rely on ingredient suppliers like Sensient to create products that are not only flavorful, but also visually vibrant and consistent.
Consistency is key.
Absolutely. Directly enhancing product appeal on crowded store shelves and increasingly on online platforms and social media feeds.
Got it. So strong tailwinds. But what about competition? The specialty food ingredients industry is also characterized by significant barriers to entry, right?
Yes, very significant. They act like protective moats around incumbent players like Sensient, shielding them from new disruptive competition.
Yeah. What are the main barriers?
One major barrier is regulatory hurdles. This industry is subject to incredibly stringent food safety regulations by global bodies, such as the US FDA and the European Food Safety Authority.
High standards.
Extremely high. Gaining approval for a new food ingredient is an incredibly scientifically rigorous, time-consuming, and expensive process. It's not something a startup can just jump into.
Needs deep pockets and expertise.
And Sensient leverages this beautifully with its CertiSure program, which we touched on earlier.
Right, the safety program.
This program certifies its ingredients against a battery of rigorous tests for pesticides, heavy metals, and adulterants. This is a key differentiator.
How so?
It provides customers with immense peace of mind and directly addresses a critical customer need, which in turn builds a strong foundation of trust.
So it's about risk mitigation for the customer.
Exactly. In an industry where one product recall can ruin a brand, this verifiable guarantee of safety and quality is invaluable. It removes a huge headache for their customers.
Their CertiSure program, as you highlighted earlier, seems to be a real cornerstone of their competitive advantage. Can you elaborate on why this particular program resonates so strongly with customers?
It resonates so strongly because it directly addresses the immense risk and complexity CPG companies face today regarding supply chain integrity and consumer trust. Think about it.
Okay.
With global sourcing, it's incredibly challenging for a large food company to verify every single batch of, say, a fruit extract coming from halfway around the world.
Traceability nightmare.
Totally. CertiSure provides that comprehensive third-party verified assurance. It's about preventing a crisis before it starts. Manufacturers know that if there's any issue with a raw material, it could lead to massive recalls, regulatory fines, and permanent brand damage.
The stakes are incredibly high.
They are. Sensient takes that burden off their shoulders, acting as a trusted guardian of ingredient purity and traceability. That's why it's a significant and tangible competitive advantage. It's a non-negotiable for large CPG companies, and Sensient provides that crucial peace of mind.
Okay, very clear. Another significant barrier you mentioned is technical integration and high switching costs.
Yes, back to the stickiness factor.
As we discussed, specialty ingredients are not just added, they are deeply integrated into a customer's specific product formula.
It's part of the recipe's DNA.
Changing a supplier isn't a simple procurement decision based on price alone. A new color or flavor can fundamentally alter the taste, texture, stability, and even the shelf life of the final product,
Everything can change.
necessitating a complete and costly reformulation and retesting process. Once a Sensient product is designed into a customer's formulation, it creates that sticky, long-term relationship with high switching costs.
Very high costs.
Finally, to compete at this level, a company needs scale, R&D, and a robust supply chain.
Table stakes, really.
To compete effectively, a company must possess a truly global manufacturing and distribution network, a resilient supply chain capable of sourcing diverse raw materials from around the world,
Which is getting harder.
and a significant, sustained commitment to research and development. These requirements demand substantial capital investment and deep institutional expertise, making it incredibly difficult for new players to enter the market at scale and compete effectively with established giants like Sensient.
It takes a lot of money and know-how.
So, connecting this back.
Yeah, if we connect this to the bigger picture, the primary growth engine for Sensient isn't merely the expansion of the overall food industry itself.
Though that helps.
It does, but it's more about the continuous cycle of premiumization and reformulation within it.
Explain that.
For example, the robust growth forecast for natural colors comes not just from new food products being launched, but crucially, from existing products being reformulated to meet clean label demands and evolving consumer preferences.
So companies updating their old recipes.
Exactly. Each time a major CPG company decides to replace a synthetic color with a natural alternative, it initiates a complex R&D project. This project is a distinct and high-value source of demand for Sensient.
Because they need help.
Right. Sensient sells not just the ingredient itself, but also the critical technical support, the application expertise, and the regulatory guidance required for the customer to successfully navigate that reformulation.
The whole package again.
Therefore, the company's growth is disproportionately linked to its ability to secure these high-value reformulation projects. This is precisely why the strong new win rate that management consistently refers to is the most vital forward-looking indicator of performance.
Because it shows future business locked in.
Exactly. It represents the successful embedding of Sensient's technology into its customers' next-generation products, locking in future revenue streams that are highly protected by those high switching costs. 3. A small fish in a big pond. Competitive landscape and Sensient's edge.
Okay, let's talk competition. The specialty ingredients industry has undergone significant consolidation in recent years,
Massive consolidation. Mega mergers.
resulting in a competitive landscape dominated by a few large, truly global players. Sensient's primary publicly traded competitors are formidable in scale and scope.
They're facing giants.
First, we have International Flavors and Fragrances, IFF. They became one of the largest players after merging with DuPont's Nutrition and Biosciences division in 2021.
Huge deal.
They reported a massive $11.48 billion in revenues in 2023. They operate across taste, food ingredients, health and biosciences, and scent, making them incredibly broad.
Very diversified.
Then there's DSM-Firmenich, created through a 2023 merger,
Another giant combination.
with pro forma 2023 sales of $12.3 billion, boasting a vast and diversified portfolio across perfumery and beauty, taste, texture and health, and animal nutrition.
Also incredibly broad.
And Novonesis, formed in early 2024 through the merger of Novozymes and Cree Hansen,
The enzyme and microbes powerhouse.
a powerhouse in microbial and enzyme-based solutions with projected annual revenues of approximately $3.7 billion. So you see, these are true giants of the industry compared to Sensient.
Absolutely. A direct comparison really reveals Sensient's distinct market positioning. With annual revenues of approximately $1.5 billion, Sensient is considerably smaller than IFF and DSM-Firmenich.
Much smaller. Is that a disadvantage?
Well, it certainly presents a potential disadvantage in terms of economies of scale and procurement and the absolute size of its R&D budget. You might think, how can they compete?
Right.
However, its smaller size may also afford it greater agility and a more focused operational approach compared to its larger, more complex rivals who are currently navigating massive post-merger integrations.
Ah, the focus versus scale trade-off.
Exactly. Sensient is a more focused pure play on colors and flavors, whereas its larger competitors have significant exposure to adjacent markets like fragrances, industrial enzymes, and animal nutrition. This specialization can be a source of deep technical expertise and a clear, understandable value proposition for its target customers who value that specialized partnership.
So despite its smaller scale, Sensient has carved out a strong competitive position based on several key differentiators that allow it to punch above its weight.
They definitely do.
First, they have deep technical specialization in their core areas, particularly in the technically challenging field of natural colors.
That's a key strength.
This isn't just a buzzword. It allows them to provide the high-touch application support that customers require during those complex reformulations we keep talking about.
It's truly a partnership, not just a transaction. They get in the weeds with their customers.
Second, management consistently emphasizes its focus on industry-leading customer service and agility, with metrics like sample turnaround times and on-time in full delivery as key advantages.
The operational stuff matters.
In a market where larger competitors may be distracted by those massive integration activities, this laser focus on operational excellence and responsiveness can be a powerful tool for winning and retaining business from customers who prioritize reliability and quick adaptation.
Being nimble can be a big advantage.
And third, their food safety and traceability with the CertiSure program.
We keep coming back to it because it's important.
As you just highlighted, it is a significant and tangible competitive advantage. In an environment of increasing consumer and regulatory scrutiny, this platform provides customers with a verifiable guarantee of the safety, quality, and traceability of the natural raw materials used in Sensient's products.
This is a non-negotiable for large CPG companies, and Sensient provides that crucial peace of mind. Takes risk off their plate.
That really brings up a crucial point when we look at this competitive landscape. What has this recent wave of mega mergers among their rivals meant for a company like Sensient? Is it purely a threat, or are there opportunities lurking in that consolidation?
That's a critical question, and it's truly a dual-edged sword for Sensient, presenting both threats and opportunities.
How do I break that down?
On one hand, it has created competitors with unprecedented scale, R&D capabilities, and portfolio breadth, representing a formidable long-term threat. These giants can indeed offer comprehensive one-stop shop solutions to the world's largest CPG companies, potentially boxing out smaller suppliers.
The bigger is better argument.
Right. They have vast resources and a very wide product offering. But on the other hand, executing such large-scale mergers is fraught with complexity and risk.
Integrations are hard.
Very hard. The process often leads to significant periods of internal disruption, management distraction, portfolio rationalization, and potential degradation of customer service as disparate systems and cultures are integrated.
Customers can get lost in the shuffle.
They can. IFF's recent performance and ongoing restructuring, for instance, are a testament to these challenges. It's not easy to combine two massive entities seamlessly.
So the giants might stumble.
Exactly. This period of integration-related turmoil at its largest rivals creates a clear window of opportunity for a stable and focused competitor like Sensient.
Opportunity knocks.
The company can leverage its reputation for agility and customer centricity to win business from customers who may feel neglected or are experiencing service disruptions from the newly merged entities.
Be the reliable alternative.
Precisely. Therefore, while industry consolidation intensifies the long-term competitive pressure, it may simultaneously be providing a short to medium-term tailwind for Sensient's new win rate as it positions itself as the focused, reliable, and responsive alternative.
Interesting dynamic.
This makes the next few years a critical period for Sensient to capture market share and solidify its position while the giants are busy integrating. 4. The financial roller coaster. From trough to recovery.
Okay, let's turn to the financials. Sensient's performance over the past 3 years tells a clear story.
A bit of a roller coaster.
Yeah, of a cyclical downturn followed by a strong recovery. It's been a journey of ups and downs, but the trajectory is now looking much more positive, reflecting that cyclical trough towards secular growth narrative we started with.
That narrative seems to be playing out. The 2023 downturn was indeed a challenging time for Sensient. Full year 2023 saw consolidated revenue at $1.46 billion, with reported operating income falling significantly to $155.0 million.
Ouch. What drove that?
The primary driver was a significant drop in sales volumes across all three operating segments. This was a direct result of customers aggressively reducing their own inventory levels.
The destocking cycle.
Exactly. It was a severe destocking cycle, where clients worked through excess stock rather than ordering new ingredients. Imagine a factory.
Okay.
Suddenly has fewer products leaving the line, but its rent, its machines, its core staff costs are still the same. That means each product it does sell now has to bear a much larger share of those fixed costs, squeezing profits.
Negative operating leverage.
Precisely. which, combined with persistent inflation in raw materials and energy, compressed profit margins significantly.
A double whammy.
It was. The impact was particularly acute in the fourth quarter of 2023, where reported operating income plummeted 80.4% year-over-year to just $8.1 million.
Wow, 80% drop.
Now, that figure was heavily distorted by a one-time non-cash charge of $27.8 million related to their portfolio optimization plan.
Ah, the restructuring charge.
Right. But even on an adjusted basis, taking that charge out, local currency operating income and EBITDA decreased by 9.6% and 8.5% respectively.
Still a big hit.
It clearly demonstrated the severe impact of those volume declines. It was a tough period, but important to understand it was largely due to this external inventory cycle, not a fundamental problem with their underlying demand or market share.
But then things turned around.
Yes, an inflection point became evident in the fourth quarter of 2024. This was a crucial turning point.
What happened?
As the destocking cycle concluded, underlying demand began to resurface. Q4 2024 reported revenue increased a healthy 7.8% to $376.4 million.
Okay, recovery starting.
And local currency adjusted operating income surged by 20.8%, driven by a strong rebound in sales volumes across all segments.
It's a strong rebound.
This positive momentum carried directly into 2025. The second quarter of 2025 saw consolidated revenue grow 2.7% to $414.2 million. While reported operating income increased by a robust 16.2% to $57.7 million.
Showing that operating leverage working in reverse now.
Exactly. As sales recovered, a larger portion of each new dollar of revenue translated into profit, signaling financial health and the efficiency gains kicking in.
And how did the different segments perform during this recovery?
The performance of the high-margin color group was particularly strong in Q2 2025. Revenue grew 6.9% and operating income jumped an impressive 23.6%.
Wow, color leading the charge.
Clearly indicating healthy demand in its key food and pharmaceutical end markets, fueled by those secular trends towards natural ingredients we talked about.
Okay. What about flavors and extracts?
Now here's a noteworthy development within the flavors and extracts group in Q2 2025, while the segment's revenue actually declined slightly by 2.8%.
Revenue down, but profit up.
Exactly. Its operating income grew by a healthy 8.8%.
How does that happen?
This divergence between revenue and profit trends points toward a successful and deliberate shift in product mix. The company noted that lower volumes in certain natural ingredients, likely those that are more commoditized, perhaps basic fruit concentrates or simpler extracts with lower margins, were more than offset by the strong profitability of higher volumes in more specialized flavors, extracts, and flavor ingredients.
Selling less of the low-margin stuff, more the high-margin stuff.
Precisely. It suggests that management is actively pruning lower margin, more commoditized product lines while focusing resources on higher value, more technologically differentiated solutions.
Strategic optimization.
Right. This is a leading indicator of the company's broader transformation strategy, demonstrating a disciplined approach to prioritizing profitable growth over simple revenue growth.
Which bodes well for the future.
Extremely well for future margin expansion and improved returns on capital. They are focusing on quality over quantity in certain areas.
Okay, so let's look at the bigger picture numbers again. Looking at the overall numbers for the last few years, we can clearly see this trend of recovery and strategic shifts playing out.
Yeah, the numbers tell the story.
Consolidated revenue went from $1,437 million in fiscal year 2022 to $1,456.5 million in fiscal year 2023.
Which was that slight 1.4% growth despite the headwinds.
Then it surged to $1,560.1 million in fiscal year 2024, representing a strong 7.1% growth.
The rebound kicking in.
And reached $1,583.1 million in the trailing 12 months, or TTM, to Q2 2025, which is an 8.7% growth.
Nice acceleration.
Consolidated operating income, as we mentioned, dipped from $196.8 million in FY 2022 to $155.6 million in FY 2024, and an even higher $208.5 million in the TTM to Q2 2025.
That's a very robust recovery in profit.
Consolidated operating margin followed a similar path, from 13.7% in FY 2022 down to 10.6% in FY 2023.
The trough.
Then steadily up to 12.3% in FY 2024 and 13.2% in the TTM to Q2 2025.
Clearly on an upward trend indicating improving profitability.
And that color group's operating margin, as we discussed, consistently outperformed, staying in the high teens, 17.5% in 2022.
Even during the downturn, 17.3% in 2023.
Right.
Yeah.
then 18.5% in 2024, and an impressive 19.3% in the TTM to Q2 2025.
That really underscores its importance as a margin driver and the strength of its competitive moat. It's their cash cow, really.
Okay, so the recovery looks solid. What about the balance sheet and cash flow?
Right. After navigating those turbulent financial waters, the question becomes, how resilient is Sensient's ship, its balance sheet, and its ability to generate cash?
Is it healthy?
The company maintains a solid balance sheet, providing essential financial flexibility. Their cash flow from operations is consistently used to fund capital expenditures, maintain a stable dividend for shareholders, and conduct periodic share repurchases.
A balanced approach.
Reflecting a balanced approach to capital deployment, it shows a company that generates cash and knows how to use it strategically.
And what about returns on investment?
An evaluation of Sensient's return on invested capital, ROIC, and return on equity, ROE, provides crucial insight into the efficiency of its capital deployment.
Okay, what are they?
According to available data, TTM ROIC stood at 8.79% and ROE at 14.09%.
And ROIC measures.
ROIC, for our listeners, essentially measures how well a company is using all its capital debt and equity to generate profits.
Got it. And ROE.
ROE shows how much profit they're generating for each dollar of shareholder equity. Both are key efficiency metrics.
So what's the takeaway from those numbers?
The trend in these metrics, particularly as the company emerges from the 2023 downturn and implements its portfolio optimization plan, will be a key indicator of long-term value creation. An improvement in these returns would signal that the strategic initiatives are successfully enhancing profitability and capital efficiency.
Proving that their investments are truly paying off.
Exactly. We want to see those numbers trend upwards. V, charting the course, strategic direction and leadership.
Okay, let's talk strategy. Sensient's strategic direction seems clearly centered on leveraging its core technical competencies.
Playing to their strengths.
To capitalize on those powerful secular growth trends, we discussed think natural ingredients and clean labels while simultaneously improving operational efficiency to drive margin expansion and ultimately shareholder returns.
A two-pronged approach, growth and efficiency.
And the cornerstone of their current strategy seems to be the portfolio optimization plan.
Yeah, initiated in the fourth quarter of 2023.
This is a comprehensive program designed to streamline the company's organizational structure, enhance productivity across their operations, and generate significant cost savings.
It's a fundamental restructuring, aiming to make them leaner and more efficient, cutting the fat, essentially.
What are the goals?
The plan's primary goal is quite clear: to deliver between $8 million and $10 million in annual cost savings, with full implementation expected by the end of 2025.
That's a decent chunk of savings.
It is. To achieve this, the company anticipates incurring approximately $40 million in pre-tax charges through 2025, of which around $30 million are non-cash asset write-downs and other non-cash costs.
Meaning they don't impact cash flows directly?
Right. This plan involves things like consolidating certain manufacturing facilities, streamlining administrative functions, and optimizing their procurement processes to reduce redundancies.
Standard restructuring moves? Are they executing?
It seems so. The company has demonstrated consistent execution, recording costs associated with the plan in each subsequent quarter, including that $27.8 million in Q4 2023, then $0.9 million in Q4 2024, and $3.3 million in Q2 2025.
So it's progressing.
This steady cadence of reported costs indicates that the restructuring is proceeding as scheduled, which is a good sign for investors looking for disciplined execution. The successful execution of this plan is critical to the investment thesis for Sensient.
Why critical?
Because it provides a clear, quantifiable path to higher structural margins independent of top-line growth. It means they can become more profitable even without a huge surge in sales, simply by operating more efficiently.
Sort of help story.
Exactly.
Okay, let's talk about how they manage their money and capital allocation.
Always important.
Management employs a balanced capital allocation strategy focused both on investing in the business for future growth and consistently returning capital to shareholders.
Trying to do both.
Sensient has a long and consistent history of paying a quarterly dividend, which is a core component of its shareholder return policy.
Income investors like that stability.
For many investors, that stable dividend income is a huge draw. This is supplemented by opportunistic share repurchase programs with the level of activity dependent on their cash flow generation and alternative uses of capital.
Buying back stock when it makes sense.
They also pursue a disciplined acquisition strategy focused on acquiring technologies and capabilities that enhance its core portfolio,
Bolt-on acquisitions.
as evidenced by the past acquisitions of Flavor Solutions, Inc., and Endemix.
Right. An acquisition like Flavor Solutions likely brought in new flavor technologies or expanded their customer base in a specific niche, while Endemix could have bolstered their natural extract capabilities.
Yeah.
Smart, targeted deals.
And capital expenditures, where does that money go?
CapEx is prioritized towards facility optimization, capacity expansion in high-growth areas like natural colors, and general maintenance to keep their operations running smoothly, investing back into the core business.
Okay. We've talked a lot about the company's strategy and financials, but a company is only as good as its leadership, right?
Absolutely crucial.
How do we assess the quality of Sensient's management team, especially given the turbulent period they've just navigated?
That's a fair question. Sensient is led by an experienced executive team with deep industry knowledge, which is critical in such a specialized field.
Who's at the helm?
The team is headed by Chairman, President, and CEO Paul Manning. He's been with the company since 2009 and has held the CEO position since 2014.
So, decent tenure. What's his background?
His background is quite impressive, actually. Includes a strong technical foundation in chemistry, combined with prior experience in supply chain management and mergers and acquisitions.
A good mix of skills.
It provides a very well-rounded skill set to lead the company, particularly in navigating complex product development and operational challenges.
And how are they incentivized? Does their pay align with performance?
Good question. Their executive compensation program is also a good indicator. It's heavily weighted towards performance-based incentives that are directly tied to key financial metrics.
Like what?
For example, annual cash incentives are based on adjusted EBITDA with a 70% weight and local currency revenue with a 30% weight.
Okay, focused on profit and growth.
And long-term performance-based equity awards are tied to multi-year adjusted EBITDA growth, again with a 70% weight, and adjusted return on invested capital with a 30% weight.
So ROIC is in there too?
Yes, this structure creates a strong, clear alignment between executive pay and the key drivers of shareholder value, profitable growth and efficient capital deployment. They're incentivized to do what's best for the business and its owners.
That alignment is key.
Furthermore, their strategic communication during the difficult 2023 period provides a valuable case study in effective leadership.
How so?
Throughout the year, as the company reported negative volume growth due to that significant customer destocking, management consistently and deliberately highlighted the strong new win rate and positive momentum in product launch activity.
Which seemed contradictory at the time.
It did seem contradictory, but it was a strategic effort to signal to investors that the underlying competitive health of the business remained strong, even if current sales were temporarily depressed.
Explain the logic.
A new win represents a future revenue stream that only materializes once a customer launches a new product with Sensient's ingredients. By emphasizing this forward-looking metric, management was effectively communicating that the pipeline for future growth was robust.
The funnel was still full.
Exactly. And that the current downturn was a temporary inventory-related phenomenon, not a reflection of lost market share or a weakening competitive position.
Did it work?
Well, the strong volume recovery that began in late 2024 and continued into 2025 has since validated this strategic signaling, significantly enhancing management's credibility.
So they were right.
It shows they truly understood what was happening and communicated it clearly, guiding expectations effectively through a tough patch.
Yeah.
6. The price of promise. Valuation and risks ahead.
Okay, so we've covered the business, the trends, the financials, the strategy. What does this all mean for Sensient's market value, valuation time?
Right. Assessing Sensient's valuation requires comparing its current trading multiples to its own historical ranges and to those of its direct competitors.
Helps us understand if it's cheap or expensive.
Exactly. Historically, Sensient has traded within a defined range of valuation multiples. Over the past 13 years, for example, its enterprise value to EBITDA multiple, has ranged from a low of about 11.7 times to a high of over 24 times,
Wide range.
with a median around 17 times. As of mid-2025, its trailing 12 months TTM EBITDA multiple stood at approximately 20.7 times.
So above the median, towards the higher end.
Definitely in the upper end of its historical range. Similarly, its price-to-earnings PE ratio, approximately 36.1 times, is also elevated compared to its historical norms.
36 times earnings. Not cheap.
No. This premium to its historical average suggests that the market is already pricing in a significant recovery in earnings and the successful execution of its margin-enhancing strategic initiatives.
So the good news is already baked in.
A lot of it seems to be. It means investors are essentially paying for future promise today, so there might be less easy upside if things just return to normal, compared to if the stock were trading at the lower end of its historical range.
So if the market has already baked in a significant portion of this recovery and future promise, what does that imply for potential upside from here? Are we looking at a stock where much of the good news is already priced in, or are there still potential catalysts that the market hasn't fully appreciated?
That's the million-dollar question for investors, isn't it? On one hand, the current valuation certainly implies high expectations. To see significant further upside, Sensient would likely need to exceed those expectations.
Beat and raise.
Right. Perhaps by achieving even faster top-line growth, or by delivering margin expansion that surpasses the $8-10 million target from the optimization plan, or by demonstrating truly transformative new wins in high-growth areas.
What's the other hand?
On the other hand, if the secular trends accelerate further, or if their larger competitors continue to be bogged down by integration issues, Sensient might be able to capture market share more rapidly than currently anticipated.
Which could justify the premium.
It could. The current multiple essentially says, we believe they will execute well. The question is, can they execute exceptionally well?
Okay. How does it look compared to peers? A comparison against its peer group is crucial for contextualizing Sensient's valuation.
Yes, let's look at the numbers. Sensient's TTM EBITDA is around 20.1 times, PE about 35.2 times.
Okay. ISF.
International Flavors and Fragrances, IFF, is at 13.4 times EBITDA, and its PE is not meaningful due to recent negative earnings, which tells its own story.
Right. Challenges there.
DSM-Firmenich is at 10.5 times EBITDA, and its PE is 30.3 times, lower multiples than Sensient.
And Novonesis.
Novonesis, as a high-growth biosolutions leader, commands a premium PE ratio of 58.0 times, very high, though its EBITDA is not readily available post-merger for direct comparison.
So what do we learn from this peer comparison?
It reveals several key points. Sensient trades at a significant EBITDA premium to its larger, more diversified competitors, IFF and DSM-Firmenich.
Why the premium?
It may be justified by several factors we've discussed. Sensient's more focused business model, its higher structural margins in the color group, and its relative stability compared to peers who are currently undergoing complex post-merger integrations.
The market values focus and stability right now.
It seems so. IFF's lower multiple, for example, reflects its higher leverage and the market's ongoing assessment of its integration and restructuring efforts. It's facing significant challenges. DSM-Firmenich's multiple is also lower, potentially reflecting its exposure to the more cyclical vitamins market.
So context matters for the multiples.
Absolutely. While Sensient might look expensive on a raw multiple basis, there are underlying business reasons that contribute to that premium. The market seems to be rewarding focus and operational stability in a turbulent industry.
And let's not forget the dividend. Sensient's dividend is also an important component of its total shareholder return.
True, especially for income investors.
As we noted, they have a long history of paying a consistent quarterly dividend. A stable or growing dividend, especially one supported by strong free cash flow, can provide a valuation floor for the stock.
Provide some downside support.
In synopsis, Sensient's current valuation is not statistically cheap. It implies that the market has a high degree of confidence in management's ability to deliver on its promises and successfully execute its strategy.
High expectations priced in, which naturally leads us to risks.
Exactly. Even with a strong outlook, what could go wrong? What are the risks that could adversely affect the company?
Right. Always need to consider the downside. First, we have business and market risks, raw material and input cost volatility. Sensient's profitability is directly exposed to price volatility of a wide range of agricultural commodities, petrochemical derivatives, energy, labor, transportation. The list goes on.
Inflation pressure.
While they try to mitigate this through pricing actions, there can be a lag, and competitive pressure can limit their ability to fully pass through cost increases, potentially compressing margins as we saw in 2022-2023.
So margin risk remains.
Definitely. Imagine if a key botanical source for a natural color suddenly experiences a drought. It could impact their costs significantly.
Okay, what else?
Customer inventory cycles, destocking. The 2023 financial year was a stark reminder.
Yeah, that hit them hard.
Large CPG customers can make significant inventory adjustments in response to their own demand forecasts, leading to sharp, sudden drops in volumes for Sensient, creating earnings volatility even if end consumer demand remains stable. It's a systemic risk in the industry.
Can't fully control their customers' inventory.
Nope. Then there's intense competition. We talked about the giants.
IFF, DSM for Minnick.
They face global players with substantially greater financial resources, larger R&D budgets, and broader product portfolios. This could lead to pricing pressure, reduced market share, and difficulty winning business with the largest global customers who increasingly prefer one-stop shop suppliers.
The scale disadvantage again.
It's a long-term risk. And changing consumer preferences, while currently benefiting immensely from the natural and clean label trend, consumer preferences can be fickle.
Trends come and go.
A sudden shift in trends or a negative perception of a key natural ingredient category could adversely affect demand for Sensient's specialized products. Imagine if consumers suddenly became concerned about a particular natural color due to new research that could pose a challenge.
Okay, what about operational risks?
Next category, operational and financial risks. First, execution of strategic initiatives. That portfolio optimization plan we discussed, its benefits aren't guaranteed.
They might not hit the savings targets.
Exactly.
Yeah.
Delays, failures to achieve targeted cost savings, or unforeseen disruptions resulting from the restructuring could negatively impact profitability and undermine investor confidence in the company's ability to deliver on its promises. Execution risk is real.
Okay.
Foreign exchange exposure. As a global company, a strong U.S. dollar can create a significant headwind, reducing the value of international sales and profits when translated back into dollars for reporting purposes.
Standard multinational challenge.
Yep. And supply chain and manufacturing disruptions. Their complex global supply chain and manufacturing network are vulnerable to disruptions from geopolitical events, natural disasters, pandemics, or facility-specific issues like equipment failure or labor disputes.
Lots of things can go wrong there.
All of which could impact production and product availability.
And finally, regulatory risks.
Yes, last category, regulatory and ESG risks. First, food safety and regulatory changes. Operating in a highly regulated industry means failure to comply with stringent food safety regulations could result in substantial fines, legal liabilities, and severe reputational damage.
Especially with food.
A product quality issue leading to a customer product recall would be particularly damaging. Changes in ingredient regulations, for example, could also force costly reformulations or render some of their products obsolete.
Constant vigilance needed.
Absolutely. And related to that, environmental, social, and governance, ESG risks. There's increasing scrutiny on the environmental, social, and governance practices of corporations.
ESG is everywhere now.
For Sensient, this includes risks related to the environmental impact of its manufacturing operations. Think water usage and emissions, the sustainability of its agricultural raw material sourcing, and its labor practices. Regulatory scrutiny of specific ingredients on environmental or health grounds, like the ongoing global review of titanium dioxide, can directly impact demand for certain product lines.
So these aren't just ethical concerns.
No, they are real business risks that can impact the bottom line and reputation.
Well,
Bringing it all together, investment thesis and open questions.
okay. So we've covered a lot of ground in this deep dive. Let's try to pull it all together now into a quick thesis.
Let's try. Weighing the bull case against the bear case for Sensient.
Right, like looking at two sides of the same coin. What's the bull case?
The bull case. Sensient is strategically positioned right at the center of powerful long-term secular trends. The global consumer demand for natural, clean label, and visually appealing food and personal care products.
Riding those big waves.
Exactly. Its strength in natural colors, in particular, provides a clear runway for sustained high-margin growth, making it a key beneficiary of this shift. The ongoing portfolio optimization plan offers a quantifiable pathway to structurally higher profitability, with those targeted $8 million to $10 million in annual cost savings that should boost margins.
Self-help part.
And the end of the severe 2023 destocking cycle has unleashed pent-up demand, leading to a strong rebound in volumes across their segments. Plus, the pipeline of new wins secured during the downturn should provide an additional layer of growth as those customer products launch and ramp up production.
Future growth baked in from past wins.
Right. And finally, its exposure to defensive non-discretionary consumer staples provides a degree of resilience, making it less vulnerable to economic downturns.
Okay, sounds compelling. What's the bear case?
The bear case. Sensient is significantly smaller than its primary competitors, which have been created through industry consolidating mega mergers. This disparity in scale could prove to be a long-term disadvantage in terms of R&D spending, global reach, and pricing power with the largest customers.
The David versus Goliath issue.
Pretty much. Also, the benefits of the optimization plan are not guaranteed, and any gains could be offset by unforeseen operational challenges or persistent inflationary pressures in other parts of the business.
Execution risk again.
And the events of 2023 starkly demonstrated the company's sensitivity to customer inventory management. Another significant destocking cycle could create substantial volatility in revenue and earnings, challenging the narrative of a stable defensive business.
The cyclicality risk.
And finally, the company's current valuation multiples are in the upper end of their historical range and at a premium to larger peers. This suggests that a significant portion of the expected recovery and operational improvement is already reflected in the stock price, potentially limiting the margin for safety and future upside potential.
The priced for perfection argument.
Something like that, yes.
Okay. So what are the catalysts to watch for that could tip the scales one way or the other? What should people keep an eye on?
Good question. Positive catalysts. Keep an eye out for quarterly earnings reports that demonstrate continued strong volume growth across all segments.
Momentum continuing.
Evidence of margin expansion that actually exceeds the run rate of the optimization plan savings.
Over-delivering on cost cuts.
And upward revisions to management's full-year financial guidance, signaling even greater confidence in the future.
Okay. And negative catalysts.
Negative catalysts. Conversely, watch for a renewed slowdown in volume growth, suggesting a faltering recovery.
The rebound stalling.
Management commentary indicating that cost savings from the optimization plan are not materializing as expected.
Under-delivering on the plan.
Or signs of a new, broad-based destocking cycle among key customers that could hit volumes again.
History repeating itself.
Hopefully not, but it's a risk.
Okay. So, we've aimed to answer some key questions throughout this deep dive, providing you with a clear framework for understanding Sensient. Let's recap those quickly. First, how has Sensient's transformation strategy progressed since 2022?
It seems to be on schedule, with clear evidence of strategic shifts towards higher margin products already underway, even ahead of the full impact of their optimization plan.
Execution looks solid so far.
Second, what is the outlook for end market demand recovery in key segments?
It looks positive, particularly with the high-margin color group showing robust demand, and management raising guidance signals confidence in continued momentum.
Third, how effectively has management navigated inflationary pressures? They've used pricing actions during peak inflation and are now seeing the positive operating leverage effects as volumes return, complemented by the cost-saving optimization plan. They seem to have managed it reasonably well.
Fourth, what are the prospects for margin recovery and expansion?
They look strong, driven by returning volumes, the targeted $8 million to $10 million in cost savings from the plan, and that strategic product mix shift towards more profitable solutions. Several levers working together.
Fifth, how does the current valuation compare to intrinsic value estimates?
It's trading towards the high end of its historical range and at a premium to larger peers, implying high market expectations are already factored into the current price. Not obviously cheap.
And finally, what catalysts could drive outperformance or underperformance?
Faster than expected growth, better than expected margin improvement, or unexpected market shifts by competitors could drive outperformance. On the downside, a faltering recovery, execution issues with the plan, or another destocking cycle could lead to underperformance.
As we wrap up this deep dive, it makes you think, doesn't it? Consider the next time you pick up a colorful snack or a flavorful drink. How much hidden technical expertise and strategic positioning might be behind that simple sensory experience?
It's really quite something.
It's a world within our world, driven by complex forces and brilliant science, constantly evolving to meet our changing tastes and preferences.
And this raises an important question for you to consider. How might these underlying consumer trends we discussed, like the demand for clean labels and natural ingredients, continue to reshape what we eat, drink, and consume in the years to come?
What's the next big shift?
Exactly. The world of specialty ingredients is constantly evolving, driven by science, consumer demand, and strategic business decisions like the one Sensient is making. It's a space worth watching.
Absolutely. Thank you for joining us on this deep dive into sensient technologies. We hope you now look at the ingredients in your daily life with a fresh, well-informed perspective.
Hope it was useful.
Until next time, keep exploring.